Hi, welcome to Main Street Macro. I'm Neela Richardson. And this week, the Federal Reserve will meet once again to decide what to do with interest rates, whether to likely raise them or hold them steady. Now, they're going to be looking at a lot of data, but the data is not playing along with the usual game plan for the Fed. You see, usually when the Fed raises interest rates, the economy, by intent, slows down. And in the process, that slows down inflation. Well, it doesn't look like that's happening this time around. And here are three reasons why. Reason number one, it looks like the economy is having a growth spurt. In fact, last week we learned that the economy grew in the third quarter by 4.9%. That's nearly double on an annualized rate the amount it grew in the second quarter at 2.1%. Now, why is the economy accelerating at this time of year? Well, that leads us to number two. It's all about the consumer, and the consumer is still spending. Despite seeing over 5 percentage point increases in short term rates, consumer spending has also accelerated in the third quarter by 4% on an annual rate. It was barely budging in terms of growth rate in the second quarter. So consumers are still strong. They're drawing down on savings, they're using credit, but yet they're still spending. Now, the third reason why the economy is not slowing down is actually my favorite reason. It's the jobs market. This jobs market is solid. In fact, we saw in the freshest data on the jobs market last week that initial jobless claims, which is an indicator of layoffs, are still very, very low. In fact, if you look at a 4 month moving average of initial jobless claims this last period versus last year, you'll see that they're even lower than they were this time last year. So what does that say? If you add up the other data that we know about the labor market, the fact that prime age labor force participation rates are higher than they were before the pandemic, that the economy still continues to add jobs at a solid pace, and that the unemployment rate is below 4%, well, you get a labor market that can support all that additional consumer spending. Now, this puts the Fed in a tricky position because they're trying to slow down all of this demand in order to contain inflation. And so the question that they're going to be asking this week is, can in spite of all of this economic growth, a strong consumer, and a solid labor market, can we still reach that 2% inflation target without raising interest rates too much more? Well, that's the Main Street Macro for this week. We'll be looking closely at that Fed decision and telling you what we think about what the next steps are for the economy. Please check out adpri.org.